Welcome to our second edition of the public sector accounting class. Today I'll be walking you through your public sector accounting exam, and this is our second session in the row. Before we move on into the class, I would like to say that please subscribe to our YouTube channel. All you need is to hit the subscribe button right here and hit the notification bell so that anytime we post a lecture, you'll be the first to receive it. Also, we have social media platforms. Facebook and Instagram. And so please go there and follow us, like our page, leave a comment, and we would love to respond to it. Before I move on to the objectives, I'd like to say that if you have any questions on this class, please leave a comment on this video and we will definitely respond to it. Thank you. So today's objectives, we'll be looking more into the accounting concepts. We'll be looking at the basis of accounting. We'll be looking into the going concern assumption, and then any other matters that may arise, we would also touch on that. So when we say an accounting concept, what do we mean? When we say a concept, what do we mean? In English, right? When we say a concept, it simply means the underlying assumption behind something. The underlying assumption behind something. It's a concept. So when we talk about an accounting concept, what we are referring to here is that these are basically extensive assumptions that underlie the preparation of the financial statements. So basically what we are saying is, what is the thinking that goes into preparing the financial statement? What are the assumptions we are using here to prepare the financial statements? That's very, very important. One thing you need to know is that most of the conventions and the principles that are applied in, business accounting are also applicable to public sector accounting. Things like going concern, money measurement concept, the historical cost concept, periodicity, consistency, a lot of them apply to public sector accounting. You need to know that public sector accounting has similarities with your normal business accounting. The only thing is that one of the few things is that public sector accounting focuses on public sector organizations. And so there are a few differences here and there. But in terms of the conventions, like going concern, money measurement, historical cost, periodicity, public sector accounting shares that with our normal business accounting or regular business accounting. So let's talk about one of the key assumptions. So when we talk about going concern, right? Let's talk about going concern. So what does it exactly mean, going concern? Going concern simply means that the financial statement is prepared with the assumption that an entity will continue to be in existence into the foreseeable future. That's the kind of assumption that goes into the preparation of the financial statement. Otherwise, there'll be no preparation of the financial statement. If you think the company is going to collapse, why prepare financial statements? But the going concern assumption, focuses on the fact that companies will be in existence into the foreseeable future. When it comes to public sector accounting, there are several factors that are considered in evaluating going concern. How do they evaluate going concern in a public sector organization? That's our focus here. One of the things is the potential restructuring of organizational units. So when you see things like restructurings in a public sector organization, it's an effort, it's an indicator, it's a drive towards going concern, towards the existence of the organization into the foreseeable future, because that's the whole purpose of restructuring, right? To make things better, to structure things in such a way that it yields the highest benefits for the organization. You also have potential sources of replacement financing. So if if a public sector organization has sources of replacement financing, then it means that in times of emergency, it can latch on to, excess cash from these replacement sources. And so that is also a pointer towards going concern. Another thing is the estimate of inflows or the probability of continued government funding. If there's going to be continued government funding, then obviously the public sector organization is going to thrive into the foreseeable future. So we will look at things like the estimates of inflow. What is our estimate for the next 5 years in terms of inflows, in terms of the funds that are coming in to support the public sector organization? Is it lacking or is it there? If it's lacking, then it means that going concern might be a problem because the organization may not be able to exist into the foreseeable future in that case. Very, very important. Very, very important. Then you also have actual versus budgeted performance. If you look at actual performance and it's in line or it's actually above budgeted performance, then it means that the entity is going to continue to exist. So these are some of the pointers when it comes to going concern in relation to public sector organizations. I hope that's very clear. Then let's talk about the basis of accounting, right? The basis of accounting. The basis of accounting simply means the methodology under which transactions are recognized in the financial statements. What is the process? What is the methodology? What is the brain behind the recognition of transactions in the financial statements? The basis of accounting, therefore, it determines the timing and amount of financial information recognized in a business's financial statements. So it determines, the basis of accounting will determine the timing, one, and the amount and the extent of financial information recognized in a public sector organization's financial statements. Don't forget that we are all focused on public sector organizations here. So we are looking at the basis of accounting because the basis of accounting will determine how transactions and events are recognized in the financial statements. Then let's look at the types of basis of accounting. The types. There are two main types, right? There are two main types that you always need to keep at the back of your mind. Number one is the cash basis of accounting. Number two is the accrual basis of accounting. So what's the cash basis of accounting? What's the cash basis of accounting? When we talk about the cash basis of accounting, it's simply where a business will recognize revenue when cash is received and will recognize expenses when bills are paid. Very simple. It's purely cash. So when cash is received and expenses are paid, that's when the business will recognize it. It's an easy approach and it's usually used by smaller businesses. Then you have the accrual basis of accounting. I'm taking the time to explain basis of accounting because it's a necessary foundation for public sector accounting. And then the accrual basis of accounting, a business will recognize revenue when it is earned and expenses when it is incurred. So this approach takes it a step further beyond just cash recognition, right? It takes it beyond that. So in the calculation of profits, we recognize revenue when it is earned. What do we mean by when it is earned? So there's times when an organization, right, would deliver goods to someone and the person is yet to pay. Once they've delivered goods to the person, there's a contract. And so even though it's a credit transaction, the company has earned it and will receive the actual cash payment in a future period. So the revenue is recognized when it is earned. And the expenses are also recognized when it is incurred. So let me give an example of the expenses. So an organization, again, would have employees, right? And so at the point where their employees are working for them, we all know that when we start at the beginning of a month, right, let's say January, people are usually paid at the end of the month, but the organization has incurred an expense from the beginning of the month as employees continue to work throughout the month. They only make actual payments at the end of the month. So under the basis under the accrual basis, revenue is recognized when earned and expenditure is recognized when incurred. Very, very important. And if a business wants to have audited financial statements are prepared in line with the accrual basis of accounting. Very key, very key. So what are the features of the cash basis? The features of the cash basis is very simple, clear and straightforward. It's all about cash. If you get the cash, you record. If you pay out cash, you record. And it follows a single entry system of accounting. It does not follow the double entry. There's a double entry, which is a debit and credit system. This one is a single entry system of accounting. And it's also not as efficient and reliable or even accurate as the accrual basis of accounting. And there's no concept of matching here. And under the accrual basis, there's a concept of matching applies. Here, there's no concept of matching revenue and expenses. And it's also not a good management tool, because usually in the running of an organization, there will be a time lag between when a transaction occurs and when actual payment is made. And so if you are recording purely on cash basis, you would miss, that piece of the pie. And it doesn't also conform to GAAP provisions. So what are some of the advantages of the cash basis? It does not require expert knowledge. Anyone can do it. So it does not require any complex accounting knowledge to be able to prepare financial statements on the basis of cash. It does not. So it's quite simple, it's quite easy to do, and everyone can follow and apply something like this. And also, since it is simple and records less number of transactions compared to the accrual system, it is less time consuming. It's quite easy, you just record cash in and out, that's it. And it's also cheaper. It's cheaper because the accrual system follows the double entry system, which records transactions in a very systematic manner. And so may require software to be able to do that for you. Under the cash basis, transactions may not be that voluminous, and it's also a single entry system. And so it might be a lot cheaper compared to the accrual basis. Very, very important. Very, very important. Very, very important. So let's go on to the next slide, which is the disadvantages of the cash basis of accounting. The disadvantages. We've talked about the advantages, so let's talk about the disadvantages. The disadvantages are that some lenders, when you go to some financial institutions, they will want to see your accounts prepared according to the GAAP, because that's what it's reasonable for them. And so some of them will refuse to lend you money if you don't have it prepared according to, the accrual basis of accounting. If the company wants to approve audited financial statements, if it wants proper audited financial statements, then it can prepare its, financial statements under the cash basis of accounting. And usually with the cash basis of accounting, there are sometimes discrepancies here and there, because like I said, in the running of organizations, there will be times when transactions are initiated way before the actual payment of cash. It's very, very normal. When people buy goods on credit, they pay later. But a transaction has been initiated, a contract has been made. And so you need to be able to handle that time lag. And the cash basis of accounting does not allow that. And so there are going to be discrepancies. Then it also offers little information, it's too simplistic, and it offers little information to make proper managerial decisions. It offers very little information. So that's something to keep in mind. That's something to keep in mind. Then let's talk about the features of the accrual basis. First of all, let's talk about the accrual basis. I think we talked about it earlier, but basically, let me repeat what I said, is that in the accrual basis of accounting, revenue is recognized when it is earned and expenses are recognized when it is incurred. Let me repeat again. Under the accrual basis, revenue is recognized when it is earned, not received, like the cash basis. And expenses are incurred. Expenses are recognized when they are incurred, not necessarily paid, like the cash basis of accounting. So that's the understanding. That's the understanding going into this. So what are the features of the accrual basis? Again, it's repeated. The revenue is recorded as it is earned, irrespective of whether cash is received or not. Revenue is based on earnings, not receipts of cash. That's why when we in the income statement, we record credit transactions. You can record credit transaction because revenue has been earned, even though cash hasn't been received yet. Another feature is expenses are matched against revenues, and expenses are matched against revenues earned. Very, very simple. So what does this mean? The raw materials consumed, for example, are matched against goods sold. The matching concept applies under the accrual basis of accounting. Expenses, or another thing is expenses which can be clearly identified with the accounting period are also treated as expenses for the period, even though they may not be directly associated with the revenue of that period. And those costs are called period costs. Period costs. Period costs. So that's also another feature of the accrual basis. Another feature of the accrual basis. It's also comprehensive. It's also comprehensive. It's a more comprehensive basis of accounting rather than the cash basis. Very, very key. Very, very important. Please take note of that. It's also another feature is that it also offers more financial information compared to the cash basis. So it helps to make proper managerial decisions. You can make proper managerial decisions based on that. So what are the advantages of an accrual basis of accounting? What are the advantages? Let's try to understand what exactly are the advantages. And the one advantage is that it helps you to realize the true profits. The true profits. Very, very important. Accrual is the most popular accounting method because it delivers a more accurate representation of actual profits compared to cash. So revenue and expenses are calculated when they are realized and based on the time frame they cover. So for example, if an organization pays rent upfront for 12 months, right? Pays rent upfront for 12 months. You don't record all the 12-month rent in 1 month. The accrual basis of accounting is smart enough to, spread that advance payment over the 12-month period. And so it helps in recording real or true profits. I hope that makes sense. Yeah, I hope that makes sense. So yeah, that's the accrual basis of accounting for you. It's a make sure that revenue expenses are calculated when they are realized and based on the time frame that they cover. The time frame that they cover. So for example, when you pay a subscription and it's for 12 months, it's for 12 months, the accrual basis of accounting would make sure that payment, if it's $5,000 or $6,000, is spread over the 12-month period. The accrual basis of accounting also helps for easy forecasting. Future expenses and revenues are taken into account with accrual, which makes simple business planning, because it incorporates future expenses and revenues, or it takes it into account. It allows for business planning, especially when you're creating budgets for predictable sales and expenses, because the future is taken into accounts. Under the cash basis, it's now. We receive cash now, we record it. We don't receive it, we don't record it, even though a transaction might have been made. Under the accrual basis of accounting, say no, even though cash might not have been received, a transaction has been created and money would be received in the future. And so that is incorporated into the accrual basis of accounting, and it helps with easy forecasting and budgeting. Then you have the tax expenses. Under the accrual basis of accounting, you are allowed to deduct some expenses on the tax returns before actually paying them. And so it affords you the opportunity. It affords you that opportunity. So businesses are able to deduct certain expenses on their tax returns when they file their tax returns. Then what are the disadvantages? Does the accrual basis have any disadvantages at all? Let's see. Under the accrual basis of accounting, there will be cash flow uncertainties, right? Because the time a transaction is initiated is different from the time cash is received. So you see cash flows uncertainties, you see transaction done in one period, but cash received maybe 2 months later. You see those kind of things. So what I wrote here is accrual accounting requires that transactions be recorded when they occur rather than when money is exchanged. Indicating the presence of profits before actually receiving the cash can sometimes pose some problems. And because of some of these problems, some organizations use this opportunity to manipulate the financial statements. Manipulate the financial statements, because somebody can tell you, oh, we expect that we will receive our cash by the end of the year, knowing that they might not even receive it. So it creates cash flow uncertainties. Then it's quite difficult in terms of calculations because you would have to keep track of your transactions and your cash receipts or payments. You have to keep track of that. So you have to make sure that is constantly in check. When you initiate the transactions, there's usually a follow-up. If it's not a cash transaction, there's usually a follow-up in terms of the receipt or the payment of cash. So you have to take note of that. You would have to take note of that. And so if you don't do that properly, it can lead to a lot of inaccuracies. That's why the cash basis of accounting is simpler, but this one is a bit complex and difficult. And this is obviously more costly compared to cash accounting in terms of even the resource, the knowledge that you need, in terms of the systems that you need to run a basis of accounting like this. Then what I needed to let you know is that there is the cash basis and there's the accrual basis of accounting, But one thing you need to know is that there's also the modified cash basis of accounting, and there's also the modified accrual basis of accounting. So this is basically a modification, a slight modification. So what is the modified cash basis of accounting? It refers to an accounting method that it utilizes the features of both accrual and cash basis methods. So it is more a hybrid form of accounting. So the cash basis of accounting is used to prepare the financials with the addition of accrual adjustments. Please take note of that. Let me repeat that again. The cash basis of accounting is used to prepare the financials with the addition of accrual adjustments. So why do they add accrual adjustments at all? Because sometimes organizations want more insights than just the cash basis accounting. Because the cash basis of accounting doesn't provide accrual insights. So organizations would want to have that understanding. They want to have that knowledge. What are the features of a modified cash basis? It follows the cash basis method of accounting for recording short-term items. It records almost all income statement elements as per the cash basis. However, inventory and account receivables are not recorded on the balance sheet. So that's one feature. It follows the cash basis method of accounting for recording short-term items. Then the next feature is that it follows the accrual basis method of accounting for recording long-term items. So for short-term items, it records it based on the cash basis. For long-term items, It records it based on what? The accrual basis. It records long-term debts and fixed-term assets on the balance sheet and the depreciation and amortization of associated fixed assets on the income statement. So what do you need to keep in mind? For short-term items, the cash basis method of accounting is used. For long-term items, the accrual basis of accounting is used. The modified cash basis also uses the double entry accounting system. It uses the double entry accounting system, which basically says that every debit entry has a corresponding credit entry. The next one is that the financial information provided by the modified cash basis method is more relevant than the cash basis method. It's more relevant. Why? Because we are maintaining a set of accrual records here. It includes accrual adjustments. Don't forget the definition we gave at the beginning. It includes accrual adjustments as well. So very, very important. So it's more relevant than the cash basis, which just records only cash. Here, accrual adjustments are included. Then let's move on to the modified accrual basis of accounting. This is an accounting method that combines the cash basis accounting and the accrual basis of accounting. It combines these two methods. Again, it follows the cash basis method to record short-term events and follows the accrual method to record long-term events. The modified accrual accounting combines the features of the cash method and the accrual method. Under the cash method of accounting, revenues and expenses are recorded when cash is received or paid. Under the accrual method, revenues are recorded when they are earned and expenses are recorded when they are incurred. Under the modified accrual accounting, method, it distinguishes between short-term and long-term events and recognizes them in different ways. Very, very key. Very, very important. So how does it do that? So let's look at short-term events. Modified accrual accounting follows the cash basis accounting to report short-term items. The short-term items on the balance sheet include things like the account receivables, your inventory, etc. The economic events that affect the items are regarded as short-term events. These events are recorded when cash balance is changed. Then we have long-term events, which are PP&E, long-term debts. Those are long-term events. And why are they long-term events? In contrast to short-term events, economic events that affect the items or affect more than one accounting period are known as long-term events. So I'm just explaining what short-term and long-term events mean here. The modified accrual accounting method also treats long-term events as the accrual accounting does. It treats long-term events as accrual accounting does. So long-term assets and liabilities are recorded on the balance sheet. Depreciation, amortization are reported over the life of the assets and debts. Very, very important. Very, very important. Another feature is that revenues are recognized when they become available and measurable. So what does that mean? Availability arises when the revenue is available to finance current expenditure. When the revenue is available to finance current expenditure, that's what we mean by availability here. Also, expenditures are recognized when liabilities are incurred. Expenditures are recognized when liabilities are incurred. And we know that this is the same approach under the accrual basis of accounting, though inventory and prepaid items can be recognized as expenditures when purchased, rather than first being capitalized as an asset. Very, very important. Very, very important. In addition, under this basis of account, which is the modified accrual, depreciation expense is not recognized. depreciation expense is not recognized there. Instead, assets are charged to expense when purchased. So let me repeat that again. In addition, depreciation expense is not recognized under the modified accrual basis of accounts. Instead, assets are charged to expense when purchased. Very, very important. Very, very important. And so if you have any questions, please, drop it in the comments and we would answer. And thank you for your time, and see you in the next lecture. Thank you.